Manufacturing plays a vital role in the economy, acting as a bellwether for economic health. When manufacturing struggles, it often signals a broader economic issue. Recently, the numbers coming out of key regions in the United States tells a concerning story. Starting with Chicago, the manufacturing PMI just came in at 36.9, significantly lower than the forecasted 42.7 and well below the neutral mark of 50. This lower than expected reading indicates a more severe contraction in the manufacturing sector than anticipated. When compared to the previous PMI score, which was also pretty low at 40.2, this continued decline highlights ongoing struggles for manufacturing businesses in the Chicago area. Factors contributing to this decline could include market volatility, lower demand, higher input costs, or broader economic pressures. Historically, contractions of this magnitude often precede broader economic slowdowns, making it a critical indicator to monitor. Moreover, the Chicago PMI is often seen as a leading indicator for the ISM manufacturing PMI, suggesting that national manufacturing activities might also face significant challenges in the coming months. And this isn't just a regional concern. It's a trend that has ripple effects across the country. Manufacturing is interconnected with other sectors of the economy, including transportation, retail, and services. For example, when manufacturing contracts, it often leads to a decreased demand for raw materials, inputs, and transportation services to move those, which in turn impacts suppliers and logistics companies. This creates a chain reaction that can spread economic strain to regions and industries that may not appear directly tied to manufacturing. Understanding this interconnectedness is key to grasping why manufacturing data is so crucial. Now, moving to New York, the picture isn't much brighter. The state's manufacturing index retreated by 31 points in December, according to the Central New York Business Journal. That's a huge drop, indicating significant challenges for manufacturers in the region. Declines of this magnitude often reflect broader economic headwinds, such as rising input costs, slowing demand, or tightening credit conditions. For New York manufacturers, it could mean that they're scaling back operations or struggling to remain competitive. This sharp contraction adds to the narrative of a challenging environment for manufacturing. It's also worth noting that New York's manufacturing sector has historically been quite sensitive to shifts in both domestic and global economic conditions, making this decline particularly noteworthy. Interestingly, not all regions are experiencing the same trend, which is a good thing. In Texas, the Dallas Fed Manufacturing Index showed an increase, rising to 3.4. This is a positive development in a contrast to what's happening in Chicago and New York. While Texas manufacturing sector appears to be growing, it raises questions about why the region is bucking the trend. Could it be due to differences in industries dominating each region, or labor costs? Or perhaps Texas manufacturers are benefiting from the unique local conditions like lower energy costs or favorable business policies. It's also worth considering whether the uptake in Texas is sustainable or if it's a short-term anomaly. Historically, Texas has had a robust manufacturing sector tied to its energy industry, which might explain some of the resilience. To understand what all this means, we need to consider manufacturing's historical context. Manufacturing tends to react early to changes in the economy. When manufacturers scale back, it's often because they anticipate weaker demand. This can lead to job losses, reduced investment, and a ripple effect throughout the entire economy. On the flip side, when manufacturing rebounds, it often signals the beginning of an economic recovery. Understanding these dynamics helps us contextualize the current numbers. Furthermore, the predictive power of manufacturing PMIs lies in their ability to signal changes before they appear in other economic indicators, such as GDP growth or employment rates. This makes them an invaluable tool for analysts and policymakers alike. Looking back, periods of contracting manufacturing activity have frequently preceded recessions or even depressions. For example, before the Great Recession of 2008, manufacturing PMIs across the country were signaling trouble. Similarly, during the early 2000s dot-com bust, manufacturing saw declines before the broader economy felt the effects. These historical parallels suggest that we should take these regional numbers seriously. The historical data underscore the predictive power of manufacturing indicators, providing invaluable insights into economic trends. Moreover, comparing current data with past trends can help us identify potential turning points or structural shifts in the economy. What should we make of the mixed signals? While Chicago and New York point to a slowdown, Texas provides a glimmer of hope. However, one region's strength might not be enough to offset weakness elsewhere. The broader trend still appears to be concerning, especially with the national manufacturing PMI remaining near contraction levels. This patchwork of results highlights the complexity of the US economy, even the global economy. It's very interconnected, where regional variations can sometimes obscure the national narrative. It also raises important questions about the uneven distribution of economic resilience and vulnerability across different parts of the country. For viewers, the key takeaway is this: manufacturing is often a leading indicator of economic health. If the current trends persist, we could see further evidence of an economy that's beginning to contract. We'll keep an eye on these things. Keep an eye on these indicators as well as other ones like consumer spending, employment data, to get a full picture of where things are headed. Tracking regional manufacturing trends alongside with broader economic data can provide a more nuanced understanding of the economy's direction. Additionally, keeping tabs on international factors such as global supply chain disruptions or shifts in trade policies can provide further context to these domestic trends. This isn't about doom and gloom, but it's about understanding the signals that the economy is sending. Manufacturing provides a window into the future, and right now, it's suggesting caution. Whether you're an investor, a business owner, or someone just trying to make sense of the news, staying informed about these trends is crucial. Let's continue to watch the numbers, keep an eye on things, and see how they develop in the coming months. If you enjoyed this video, please give it a like, subscribe, and let me know below. Do you think this is just a red herring? Do you think everything's going into a contraction? What do you think's going on in the economy? Thank you so much for watching, and I'll see you next time.